Hello everyone, hope all is well and hope you are preparing well for your exams. Today let us quickly solve, and I'm hoping that before you watch this lecture you solved the June pre-mock 2026 at your end first. Watch this only after you've solved it so that you can compare and understand and relate as to how do you end up attempting these questions. Let me solve just the first section C question to be able to guide you on how this is to be done. Let us first read the requirements of the question. Requirement is let's start with reading the requirement first. Calculate the net present value of the proposed investment and comment on the financial acceptability. So this is a typical NPV question, it looks like. The scenario relates to three requirements. While Veloisco is a profitable company that is considering a new project to manufacture a new product called vPro. The project requires an initial investment of 1,20,000 for a new machinery, and this is payable immediately. So this is year zero initial investment. This machinery is expected to have a 4-year economic life, okay, after which it will be sold for a scrap value of 200,000. So this is the scrap value, and the best suggestion would be that you keep writing all of these in your spreadsheet as well so that you don't have to read the question again and again. So initial investment is going to be 120,000, correct. Then scrap value at the end of year 4, your scrap value is going to be 200,000. This is year 4, this is year 0. Clear? Now for tax purposes the company pays corporation tax at 20% but paid 1 year in arrears. So one year arrears, okay. The company can claim the tax allowable depreciation at an investment rate of 25% per annum. So TAD at 25% on reducing balance method, okay. Reducing balance, be very careful, don't consider straight line, okay. Reducing balance method. Then with any balancing adjustment occurring upon the disposal of the asset, so you have to adjust the scrap value through balancing charge or balancing allowance, okay. Sales are projected at 10,000 units for the first year. So sales volume in year 1 is 10,000 units, okay. Then they are saying will grow annually at 5%, annual volume growth, at 5%, okay. At a selling price. So what is the selling price? This is current price terms, remember this is the real rate that is given, 150 per annum. So this is the year 0 value. You will have to calculate year 1, 2, 3, 4. Inflation is 4%, so you will have to consider the inflation at 3% per annum. So 3% per annum. Contribution is forecast at 60%, which means variable cost is 40%. So I can write variable cost 40% of sales, correct. Then fixed costs are set at 250,000, inflating at 2% per annum, 250,000. But this includes 100,000 of overheads. Remember we had studied that overheads are non-relevant. Overheads are anyways getting incurred irrespective of whether they get allocated to you or not. So you will consider the relevant fixed cost. Relevant fixed cost is 150,000. Now what is the inflation? This is also in current terms. So what is the inflation? Inflation is over here 2% for fixed costs, 2% per annum, okay. This 150,000 is year 0 value, correct, because this is in current terms. Then Velois uses the real cost of capital. You have to use the Berger equation, the Fisher equation, remember. So real cost of capital is 8%. General inflation is 3.7%. that is general inflation, correct. Now you'll be able to calculate the nominal cost of capital using this. What else is given? The finance director is concerned that the cost of initial investment may change and has so asked for sensitivity analysis to be performed to make decision on Wipro. Okay, let us start with calculating the nominal cost of capital. Okay, so what is the nominal cost of capital? Let me just write nominal cost of capital. How do you calculate it? Remember, 1 plus I, which is the nominal cost of capital, is equal to what? What was the equation? I am writing this for your benefit. Otherwise, even if you don't write the formula in exam directly, calculate, it's also okay. 1 plus R into 1 plus H, the burger equation, the patty and the cheese on the top. So 1 plus I is equal to what? What is 1 plus R? 1 plus, what is R? R is given at 8%, multiplied by, what is H? 3.7% is given. Okay, so 1 plus I is equal to 1.11. You reduce 1 from this will give you I. What is I? And you consider this into percentage terms. Okay, consider this into percentage terms. So this is your nominal cost of capital. Okay, this is your nominal cost of capital. Clear? Now what next do? We will have to, let us calculate the cash flows. Okay, let us calculate the cash flows. Year 0, 1, 2, 3, 4 and 5 also, because tax are in arrears. It's a 4-year asset, but there will be a 5th year tax cash flow. What is the sales volume? What is the sales price? Let us first calculate sales volume into sales price and hence the total sales. Clear? What is the sales volume? The sales volume is expected to be 10,000 units in the first year. Let me link this from here. 10,000 units over here, we had written 10,000 here. Then I have said it will increase per annum by what rate? So I will say 10,000 into 1 plus, okay, into 1 plus, annual growth is 5%, but I will fix the value of the 5%. I'm not sure the shortcuts work. Shortcuts don't work in the practice platform, so no problem. I will, one second, let's say this multiplied by 1 plus, or the easy way out, what I can do is, okay, that's also fine. Let me not 1 plus, again 5%. Clear? Into 1 plus the same 5% over here. Clear? Okay, year 5 there is no sales. It's only a 4-year project. Okay, remember. Now sales price. What is the year 0 sales price? Year 0 sale price was given at 150. This is the year 0 amount. Now you will have to calculate this multiplied by 1 plus, what is the annual inflation? The annual inflation was 3%. I am typing 3% so that I don't have to link again and again. Okay, now I will copy the same formula and paste it. 1 second, it doesn't look like this. It's pasted. 1 plus 3%. Okay, and okay, clear? Now if you see, this is all linked. Now. Okay, clear? Now what is the total sales? Total sales is sales price into volume. Okay, this will give you my total sales. This F24 H I. Okay, now this is clear. Let me just make these a little broader. Okay, clear? This is total sales. Now what is the variable cost? Or can I calculate the contribution directly? I can calculate contribution also directly, or I can calculate the variable cost also, whichever way. Let me leave a row. Contribution. Okay, what was the contribution? Contribution was 60%, variable cost was 40%, so I will say 60% is the contribution. Okay, what will I do? I will multiply this by 60%, copy, paste, copy, paste, copy, paste. Okay, now this gives me my contribution. Now sales is irrelevant because I directly have my contribution. Okay, I'll start my cash flows calculation from contribution because sales I've already considered in contribution. Now relevant fixed costs. Relevant fixed cost was what? Remember, the relevant fixed cost was 1,50,000 in year 0. 1,50,000 in year 0. Let me put it over here under year 0 actually. Okay, 1,50,000 in year 0, and this grows at what? 1,50,000 grows at, it is growing at 3%. No, it is growing at 2%, 1.02. Okay, now I will copy and paste this here. This grows, this is not getting copied, I guess, no problem, into 1.02. okay, it is not getting copied, into 1.02, this again into 1.02. Clear? I can do it in one more way, which is what? I can say this multiplied by bracket 1.02 the whole raised to 1. This is another way of doing it. Okay, this is one more way of doing it. Never mind. Okay, and then you can do 2, 3 and 4. That is one more way of doing it. Okay, so this is contribution minus fixed costs. Now it is, you can say profit before tax. So you can say PBT, profit before tax, is what? Contribution minus fixed cost is your profit before tax. Without considering depreciation, we can calculate the depreciation separately. The tax allowable depreciation, the tax benefit, we can calculate separately. Okay, now what is going to be the tax cash flow? What is the tax rate that is given? Tax rate was given at 25%. Tax, or 20%. Tax is given at 20%, but this is 1 year in arrears. So year 1 cash flow will be paid in year 2. Okay, year 2 cash flow will be, tax will be paid in year 3. Year 3 will be paid in year 4, and year 4 will be paid in year 5. Clear? Is it clear up to here? Any questions? Please put it in the chat box. Okay, dragging also works. So basically I can simply drag it this way, and simply drag it this way. 1 second, this needs to be fixed, that is the issue. Let me just put it here. Once you multiply, you can simply drag. This spreadsheet is a little painful, so just be careful. Okay, 1.02, 1.02, as you see, this is linked with the previous cell. Okay, now tax, the same thing. I can simply drag again. Anyways, I've done, but if you want, this is the other way, you can drag it. Okay, clear? Now you will have to, and tax has to be a negative number actually, so let me put a minus. Okay, tax has to be a negative cash outflow, correct? Tax is a negative cash outflow. I am putting this in bold because now I don't have to consider contribution and fixed cost because it is already considered in profit before tax. Now you have to calculate the TAD. Let us put it in a working note here. Working note 1, tax allowable depreciation. Okay, tax allowable depreciation. What is the value when you bought it? It was 120,000. No, not 120,000. It is 1.2 million. Okay, then what is the depreciation for year 1? It is 25%. It's 25%. And then I will say what is the year 1 closing value? Year 1 closing value is 900,000. Year 2 depreciation 25%. Year 2 closing value is 675,000. Year 3 depreciation is 168,750. Year 3 closing value, so I will just keep writing quickly. Year 1 depreciation, year 2 depreciation, year 3 closing value we now know. Now what do we do? From this is the amount which is yet to be received as deduction in taxes. I will do what? I will reduce the less scrap value. What is the scrap value? 200,000. is my scrap value. In the fourth year, I will sell it for 200,000. So this is the amount which is the balancing charge, or rather balancing allowance in year 4. This is the amount in year 4. Now what is the tax benefit that you get? Tax benefit on each of these cases, tax is 20%. So 0.2. I will copy the same formula. It doesn't get updated, no problem. 0.2, 0.2, and last year in year 4 your charge is this multiplied by 0.2. Clear? This is the benefit that you get in which year? In which year do I get this benefit? Year 1 tax benefit I get in year 2. Year 2 tax benefit I get in year 3. Year 3 tax benefit I get in year 4, and year 4 tax benefit I get in year 5. Any questions still here, guys? Any questions? Clear? Super. Done? Now let us link all of these. Tax is a benefit, TAD is a benefit, so it will be positive cash outflow, or a positive cash inflow, I would say. Nothing in year 1 because my first benefit is in year 2. So I will link the 60,000 in year 2. Then I will link the next amount, which is 45,000 in year 3. Then I will link next amount in year 4, 33750, and next amount I will link in year 5, 61250. Clear? Is this clear? We had to do all of these values negative, so I am dragging it now. Okay, all of these values are now negative. Okay, clear? Is the tax allowable depreciation benefit. What else are we missing? Scrap value. What is the scrap value? 200,000 received in year 4. Okay, this is not received in year 5, this is received in year 4. Only the tax benefit goes to year 5. Okay, anything else we are missing? Let us quickly check the question. Initial investment, we had to, how do we miss initial investment? We can't miss initial investment. Always read the question again to see if you've missed anything. Initial investment is negative 120,000, no, 1.2 million, correct? 1.2 million. Okay, anything else? Let us quickly see. Machinery, 4-year economic life, sold for 200,000. Company pays corporation tax, we've done. Tax arrears we've done. 25% reducing balance we've done. Sales projection is done correctly. Sales price was 150. Current year terms we've inflated at 3%. Contribution we've considered. Fixed costs are set at 250 minus we've considered 100,000, so 150, and then we've inflated at 2% every year. Nominal cost of capital we've calculated. Okay, all done. So what is the total cash flows? This is the total cash flows. Now over here you will sum what all numbers? You will sum all the numbers starting from profit before tax, because remember sales has already been considered in contribution and fixed costs are already considered in profit before tax. So this should be your sum. Okay, now I will just drag the formula till year 5. Clear? So these are my total cash flows. Don't worry about formatting. ACCA Institute says we don't need good formatting. It's okay. All we need is good answers. Formatting doesn't matter to us. If you really want to format, why not? But it doesn't change the answer. Remember the NPV formula. NPV, first you have to put the rate. Rate was 12%. We calculated 12% nominal rate above. Then all the values from year 1 to year 5, correct? And then you separately add year 0. That is what we had discussed for NPV use. Okay, this is your NPV. This is your NPV, which is 1253408. This is your NPV. This is your answer. So answer is done. And then calculate the NPV and comment. Don't forget to comment. You'll have to put your comment. So comment. What is the comment? You will say, given the NPV for the V-Pro project is positive, we should, not we, let's say Veloisco should accept the project basis positive NPV. Clear? Clear? Any doubts before I go to the next one? Any doubts, guys? Going to the next one. Calculate the sensitivity of the project to the change in initial investment, ignoring tax effect, and comment on its meaning. What is the NPV again? Let us copy the NPV and paste it here. So 1253408. 1253408 was the NPV. NPV is what? 1253408 is my NPV, correct? What is said? We have to calculate the sensitivity of the project to a change in the initial investment. If the initial investment was changed, then what happens? What is the initial investment? Initial investment given in the question is 1.2 million, correct? How do you calculate sensitivity? Sensitivity formula was present value of change in variable, or present value of the variable which is changed, which in this case is initial investment divided by NPV, correct? Which is 1200. Actually, one second, if you put the reverse formula, it should be NPV divided by present value of variable changed. Okay, clear? So what is NPV? 1253408 divided by 1200,000. Okay, and this you have to answer in percentage terms. Clear? So what is our NPV? What sensitivity is 104.45? What is the comment? We have to comment also. What is the comment? Comment is initial investment needs to change by 104% to reduce NPV to 0. However, is it possible? It is not possible that the initial, actually it can change, it can go upwards, however the it can increase, the initial investment can increase to, let's say, 2.5 million, in which case the NPV might become 0. However, given the sensitivity percentage is too high, this is a low risk variable given highly unlikely for it to change by 104%. You don't have to write a lot. See the marks also, it's only 2 marks, right? It's only 2 marks, guys, right? 1 mark is for calculation, 1 mark is for the comment. Okay, very simple. Moving ahead. Any queries? And please repeat the NP portion in this question, please. Sorry, what do I have to repeat? Part A or part B? What should I repeat? Part A or part B? Part A or part B? Part B. Okay. What is the formula? The formula is NPV divided by the present value of variable changed. Initial investment is anyways a year 0 number. So you don't have to separately calculate a present value, correct? What is your NPV? NPV was 1253408. We just calculated the NPV in the previous scene, right? Previous screen. 1253408.9. You can do 0.9 also, it won't change the answer. Okay, correct? Ignoring tax effect. So so the question is that this says you have to ignore tax effects. You have to ignore tax effects. See, what happens is, if your initial investment was to change, if your initial investment was to increase, technically speaking, your tax allowable depreciation also changes. If your initial investment was to increase from $1.2 million to $2 million, then your annual depreciation would have also changed, which means your tax allowable depreciation would have also changed. So technically speaking, you should consider that also. You should consider the change in the tax allowable depreciation and the incremental tax savings also, and the present value of that also. We have said do not consider any of it. You just consider the initial investment. Anyways, tax is more relevant from the perspective of when you have, for example, if they say sensitivity of contribution, or sensitivity of sales, or sensitivity of variable cost, or sensitivity of fixed cost. In all of those cases, you have to consider the present value after giving effect to the tax, which is net of tax. No. So okay, so the question is, Should it be NPV without considering tax? No, they are saying if the change in the initial happens, right? If there is a change, NPV being the same, if there was to be a change in the initial investment, then because of the change, if there was going to be any tax effect, that effect you ignore. Don't calculate NPV again. That is not what they are saying. They are saying assume there is a change in the initial investment. What is the sensitivity to the change in initial investment? And while calculating this sensitivity, ignore any tax effects that might come because of the change. So if my initial investment changes, what is the tax effect? The tax effect is the tax allowable depreciation, but that you have to ignore. It is not saying that you have to ignore tax effects while calculating NPV. No. See, also when a confusion like this arises, just see the marks. It is 2 marks. They will never expect you to calculate NPV again without taxes. No. They will simply say, in fact, the reason they are saying is initial investment, right? The initial investment. They will simply say initial investment you need to consider versus NPV. The calculation has to be as simple as this, and this is 1 mark for this, okay? And then the second mark is for the comment, okay? Let us quickly move to the next one, which is discuss the benefits and limitations of sensitivity analysis and suggest another way to assess uncertainty. What are the benefits? First of all, benefits of sensitivity analysis. What are the benefits of sensitivity analysis? It helps us understand the sensitivity of different variables to the NPV. How does this help? This calculation helps the management assess which variable has the highest sensitivity to the NPV, and such variable or variables need to be paid close attention to while assessing the project, as well as during the project, since these variables can change the NPV and hence the decision of the investment. Okay, that is how sensitivity helps. Okay, but what is the biggest limitation? What is the biggest limitation of sensitivity analysis? It considers only one variable. At a time in isolation of movement in other variables. However, in reality what happens? In reality, most variables move together. Example, in a recession, not only would the wood sales volume change, but price and cost will also change. Correct? Is this making sense? Clear? This is the key limitation of sensitivity analysis. Correct? I will unbold this. Clear? So what do you do? Alternate way to assess. What is the alternate way to assess uncertainty? Remember, in the class we had discussed that there is an alternate way that addresses this problem. What is the problem that this one assesses? What is the method that changes the answer to this problem? What is that one problem, that method? Simulation analysis considers changes in many variables at the same time. This helps overcome the limitation of sensitivity analysis. One can assess through simulation the probability of getting a positive NPV across scenarios, and basis whether this probability is high, can assess the project, can assess the investment. Clear? See, you see, this is 6 marks. 6 marks. 2 marks for each. 2 marks for benefits, 2 marks for limitations, 2 marks for the alternate way. That's it, guys. It's only 2 marks each. It's only 2 marks each. Okay? It's only 2 marks each. Now let us quickly look at the solution. And compare versus the solution. Okay? Okay? Now if you see the solution on your left, you see that the NPV is calculated exactly the way we calculated. They've also calculated sales. They've just created a separate working note for sales. If you want to keep it separate, it's okay. Even if you don't keep it separate, it's also okay. But make sure you don't make a mistake. You should not, again, for example, you include PBT also in your cash flows and you include contribution in your cash flows. Don't make that mistake. Right? So if you want to create a separate working note, if that helps. Okay? Then they've also considered the TAD in the same manner that we considered. Okay, clear? So their NPV is also 1253409. Ours also over here is 1253409. Remember, in ACCA, they will say that the formatting does not matter. Effectively, what matters is the answer. Except the project has a positive NPV will increase shareholder wealth. Okay. They've also calculated the money rate as 12%. Clear? Now let us see the marking scheme. This is why I wanted to show the suggested answer. If you've calculated a sales figure correctly across all years, you'll get 2 marks. See, even if someone has not found the correct NPV, if you are one of those, then remember, if you've not calculated the entire thing, don't worry, you'll not use the entire 12 marks. As long as you calculated sales figure correctly, you get 2 marks. If you've calculated contribution or variable cost calculated, another 1 mark, which is multiplying by 60% gives you 1 mark. Fixed assets including deduction of central cost. Why real fixed cost, right? Not fixed assets, fixed costs. Will give you another 2 marks, guys. Okay, inflation plus the step on overheads removal. Tax in arrears, again 1 mark. Even if you've considered tax in arrears, even if the number of tax was wrong, but even if you just considered it 1 year later, that 1%. TAD savings in the correct years, again it's not just the amount but also in the correct years you get 2 marks. Correct years as in again 1 year later. Initial investment gives you 0.5 marks, scrap gives you 0.5 mark. Even just putting the initial investment in year 0, putting the scrap value in year 4 gives you half a mark. Discount rate calculation of 12% gives you 1 mark. Use of NPV function or discount factors as the case may be gives you 1 mark. Comment finally gives you 1 mark. So out of 12 marks, even if your answer is incorrect, even if you've done some of these steps correctly, you can easily score 7, 8, 9, 10 easily marks you can score even if one of these steps was incorrect. Okay, let us go to the next one. Next one was very simple and quick. Let us see the solution and let us see the breakup of the marks. I'm 100% sure the breakup would be 1 mark calculation and 1 mark on comments. What are they saying? They are saying sensitivity is 104%, basically NPV divided by present value of initial investment. This means the initial investment will need to increase by 105% before the project's NPV becomes 0. Put an interpretation, this would require a huge increase in the initial cost and hence unlikely. Okay, 1 mark calculation, 1 mark discussion. Super simple. Okay, moving to the next one. Next one is your theory. What have they said? They have said, by the way, they always will write bigger. This is only a suggested answer. Remember guys, you don't have to write so much in the examination. Always remember. Sensitivity analysis identifies key variables which have the greatest impact by calculating the percentage changes required to reach the NPV to 0. Can prioritizing monitoring high risk areas, we've also written that only, which variable has highest sensitivity, pay close attention, right? Which will change the decision, correct? Helps us understand the sensitivity of different variables. We've written one more point that it is a quick and a simple tool. We can also write this. Okay, it is a simple one. Simulation is difficult. This is very simple. Only assesses one variable at a time, correct? Only assesses one variable at a time, but in reality multiple variables can move together, correct? As a consequence, as a second point. Next one is simulation can be used to consider thousands of possible project outcomes by considering multiple variables at the same time. We've also written always considers changes in many variables at the same time, correct? This is a very important improvement since this helps improve the limitation of sensitivity analysis. We've also written the same thing. Okay, this results in probability distribution, so useful to show the range of potential outcomes before making a decision. Okay, range of potential outcomes. So we've also written probability distribution, and you can assess the investment. Okay, so I've written different words, I've written my own words, they've written different words, but that's okay. You'll still get those marks even if you write in your own words, as long as the points that you've written are correct. 2 marks for benefits, 2 marks for limitations, and 2 marks for other way to assess uncertainty. I hope this is helpful.